So credit partners typically need to be at least 20% ownership for this to work, right? We've covered that in previous calls, but that's typically where you want to be at. 20% ownership is where, if let's say both of you guys wanted to be on a Chase Business Inc., remember, it's a Chase Business Inc., not just for the business, but it's a Chase Business Inc. per person in the business. And so husband, wife, literally happened in our program. Husband, wife, husband applies for Business Inc., wife applies for Business Inc., husband gets 25K, wife gets 35K. They inside of the same LLC. But in order for that to work, you got to be at least 20% ownership. For most banks, at least 20% ownership is going to be kind of like the key, right? Where you can have that person on the application. Now, the other thing I like about this is that with that 20% ownership, you probably have, or even more, right? 20% is the baseline. If you're running 50-50, maybe you got relationships with Chase, US Bank, and M&T. And maybe your partner has relationships with Fulton, Ameris Bank, and Synovus, as an example, right? Synovus is maybe not the best example, but I'm just thinking about them because we're out here in Florida. And so that's a way that you can kind of stretch out your horizons with the type of funding that you can get, because now you have 6 banks with 6 different relationships built out, versus if you were just to try to go out and do one or do all 6 on your own. It gets, again, read differently inside of the algorithm with them. Shelf and H Corps, though, because it is an option and it does give you more reach, but I do want to talk about what it is. And I also want to talk about kind of like the pros and cons about it, right? So bare bones basic, an H Corp is a company that shows no current activity and has been put on the shelf to age, hence the name, Shelf Corp, H Corp, usually used interchangeably, right? So I buy an LLC here in Florida. I decide not to use it, but every year I file the taxes on it. I file a 0, no income made. I do my business revenue. I do I renew my articles of organization. I, update my business licenses, the whole 9 yard, keep the businesses or keep that entity alive. I'm pretty much sitting that thing on a shelf. So that way, if and when I decide to either sell it or if and when I decide to open up a business with it, I have the age so that I can take advantage of a ton of the programs that we covered here today. So the company is pretty much sold by a person or by the group who started it without having to go, or the person who buys it can pretty much buy it from a person or a program or a company without having to go through the same process that maybe someone would if they just started an LLC from scratch. Now, why do people buy this stuff? People buy this stuff because they pretty much want to, and I'm going to read it off to you exactly how I have it here, because I don't want anyone to kind of misconstrue why people are doing it and if it's legal or if it's illegal. I'm going to give you my exact thoughts on it. So you're pretty much bypassing the waiting period that you would usually have to wait in order to qualify for certain funding programs. Remember what we mentioned earlier, some of these banks are going to require 1 year. Some of them are going to require 2 years in business. If you get yourself a legitimate shelf corp that's 3, 4, 5 years old, you can bypass some of that waiting period. But I want to kind of share with you exactly how that happens. You're able to immediately qualify and bid on government contracts. I actually learned this right here from one of my clients. And so he kept getting kind of like outbid because he didn't have, I guess, and I'm not like the most savviest person with government contracting. So I'm kind of going off of what he was kind of giving me. He was under 2 years. And so what he did was he pretty much had to partner up with someone who had an entity set up for 5 years. And so they were able to bid on bigger contracts through that entity. So they kind of set up like an umbrella structure. So it was almost like a partnership. Now, obviously, I know there's people in here that this is what you guys teach, but I'm going based off of kind of like what worked for him, right? So with bidding on government contracts, that really helped them out and could probably help you out as well. Convenience on securing more funding, which is what most people probably want to get a shelf corp for, is you just want to secure more funding. And then it's also going to season an older corporation. So the date that it creates, the credibility is enhanced, and it's going to position you faster if set up correctly. The other side of it, which I won't spend too much time on, is obviously asset protection and privacy. But here's some cons on the shelf corps, and then I'll kind of give you my thoughts on it. They can come with some tax liens, some tax issues, some UCC filings attached to them. So be wary of that. Second thing, something known as Secretary of State data harvesting. Here's what that means. I know it's on your screen, but I'll break it down in real time. So let's say that I have, or I see an H Corp, or I see a corporation that's on Secretary of State, ABC LLC. It's on the Secretary of State. and it's, let's say, 30 years old. I say, ooh, that thing is 30 years old. I saw that it's been out of business though for about 10 years. Let me reinstate it. I reinstate it, get everything lined up. Doesn't have any tax liens, doesn't have any UCC filings. Like, it's clean. Like, you would think from the outside, it's clean. I go out and I resell it. Most people would think that, oh, wow, he picked up a gem. He has a 30-year age corp. But the issue with that is that the way that the bank is going to grade it, since there's a 10-year hiatus, is how they market. Let's say off for a decade. Some banks do a 5-year span. Let's say if it's off for a decade for the purpose of this example, they're going to say that this is a new corp. And they're actually going to grade it as a new corporation that just got reinstated. And so when you're going out for funding, it's a reinstated entity. So it's not an actual aged entity. Something to keep in mind. It also carries, another con is you can also be sold an age corp with bad reputation on it. Kind of like having a bad reputation on, let's say, Google, Yelp, crappy Facebook reviews. And then somebody says, oh, let me sell this business off. And then somebody inherits all the bad reviews. Same thing. Kind of like, hey, we're under new management. And that's like the restaurant's trying to pick things off the ground. Like, hey, we got new cooks, we got new management. And they're like really trying to get out there. It's going to be the same thing with this, trying to prove it to the bank. You have a bad reputation. No one wants to touch the file. And then thinking that the age alone is all that's needed for business funding. So this is my thoughts on it. This is where I kind of dropped my cap on here. Shelf corps, are they illegal? No. Are there ethical and unethical ways that people are selling them? 100%. There's ethical ways that people are selling them, and there's unethical ways that people are selling them. I don't have a slide on here that is giving anyone where to buy them, because I want you guys to do your own homework. The reason why I want you guys to do your own homework is because I don't want it to be one of those things where you buy it, let's say, off of a website that you saw here, and then you get pretty much bit in the butt. So I would rather see you guys go out and reinstate, or rather not reinstate, keep your entities open. If there's a fee that you can go back into, obviously it's been less than 10 years, because I spoke to some of you guys last week. Say, hey, Irv, like my LLC, it's like I let it die out last year. Like, can I get it back? Can I get it open again? Pay the fees if it makes sense for you, right? Pay the fees if it makes sense for you. Get it open again. I've seen far better results where people build out their stuff from scratch versus buying aged entities. Now, again, I'm not saying that it doesn't work, because I know people in the space. But again, I'm just not comfortable enough, because I've seen it 50-50. So it's like flipping a coin. So here's like another indicator. If somebody's selling you an aged corp that has $200,000 line of credit available on it, and they're giving it to you for $5K, run. If somebody is selling you aged corps and they're saying, hey, it comes with these tax documents, built out business credit, $5-6K, run. It's worth way more than that. It's worth way more than that. And so that's kind of like where I want to leave it in. And so my two thoughts on this is, again, I'd rather see you build it out than buying it out, because it's going to be a lot safer and it's something that you can control. But again, I'll leave it up to you. That's why I wanted to give you both sides of the board, so that way you guys know which route you want to take. We got foreign entities, which is like the other way that you guys can access more funding and kind of bypass geographic locations. So here are the pros of a foreign entity: is you can expand the geographic fundability for your business, or the funding ability for your business. If you plan on selling products or services in another state, this is going to be a good look for you. And then third is you plan on hiring inside of another state. I want to give you guys both sides of the coin, though. Here's the other thing. If your filing and record keeping sucks, this could get messy real fast. The reason for that is what I have listed all the way at the bottom. There's something known as nexus. Nexus means that your business has enough presence inside of another state for you to be what they consider engaged in business in that state, which means that you're going to also get taxed in that state. So when you're doing your research on which state, Rad nailed it earlier, where he said, hey, you may want to consider taking a look at states that don't have any type of state taxes, right? Because if I go and let's say I have 4 banks that I want to hit in Cali, and part of my business is e-com, and I say, you know what, let me go to Cali. Things are going pretty good. I hit 4 banks. I get $250,000 in funding. And I say, I can probably buy products out here for cheap or cheaper than what I maybe can out here in Florida. And maybe I can have like a small little distribution center. I can maybe hire like a small rep to maybe ship it out of a little warehouse. Congratulations, Irv. You've just now created something called Nexus, which has now become a taxable event, which means that I'm now going to have double tax. I'm going to be taxed here in Florida, and I'm also going to be taxed because I have enough business presence in Cali. So now I have to pay, I'm not even sure where you guys are at, 50, 60% in taxes just because of the way I'm set up now. And so I want you guys to know that, because you want to pick wisely, and then you want to make sure of not to do too much to get you over the line to create that taxable event. So when you're setting up your foreign entities, make sure that you're established right. Like, try not to do too much is what I'm saying. If you guys are kind of catching my flow here, trying to speak with code, so that way you guys aren't hit with taxes. So working with the banker is the other one. I touched on this a lot last week. So if you guys haven't checked that out, working with the banker, relationship manager, they're essentially able to submit your applications for you on your behalf. They're
Irv
also
has them all in his program. He has them all in his program.
So all we do. And so that's pretty much what we do with our clients. So once they're ready to go, we lock them in with the relationship managers. And so pretty much our relationships become their relationships. And so the only thing that we ask them is like, yo, just treat them right. You know what I mean? Like, you came through us. And so just make sure that you're treating these people right, because obviously they're trying to hit their numbers in the bank, and you're trying to hit your numbers in your business. And so it's a two-way street. So with them, like I mentioned last week, they apply on your behalf. They can submit it to underwriting on your behalf. And if something comes back flagged, they'll let you know what it is. So on top of the EWS stuff that I shared with you guys earlier, you also get it here with them. Now, you want to ask for credit limit increases before activating accounts. So if you get like 2 or 3 business credit cards and you're like, man, 20K, I thought I would get 30, 35. Ask for the limit increase before you activate any of the accounts. That right there alone could probably trigger an extra 5 to 7K bump. Not always, no guarantees, but it can trigger that. And you also save yourself a hard inquiry. It's like a little